Ladies and gentlemen, pause for a moment and mentally rewind to yesterday's session. Don't look at the headlines or charts. Look at the market's mood, the holiday quiet, the manufactured calm, the sense that nothing huge happens while attention is elsewhere. That calm wasn't stability, it was emptiness. And in this market, emptiness is simply incredibly dangerous. Yesterday, I fired up this camera and issued a red alert warning. I said the market structure was broken. I said liquidity had quietly vanished. I said we were standing in a room full of gasoline pretending it was fine while someone reached for a match. Most importantly, I told you when the market reopened, price wouldn't move incrementally. It would surge. That is exactly what actually happened. Silver didn't grind up, it didn't rally in waves, it gapped up. In a short holiday session, price leapt nearly 4 fiat dollars and briefly hit above 75. This wasn't enthusiasm, it wasn't speculation, it was pure physics. There were no sellers, no depth, no resistance, just open air. This was not a rally, it was a massive market dislocation. Traders went offline with silver in the low 70s and returned to find their short positions erased. Not slowly unwound, instantly destroyed. That is what happens when deep liquidity disappears. The rules change, cents turn into dollars, survival replaces strategy. Today validated everything we have been discussing here. Ghost Week was never a time to relax. It was a stress test. And the only participants who passed were the ones holding something real, while others were holding paper promises. This move was not panic buying. It was not a squeeze. It was the fiat system revealing how fragile it really is. Once a market shows you how easily it can break you, stop asking if another move is coming and start asking how violent it will be. Because this was not the main fire. It was really just the spark. If this analysis helps you see the rigged market more clearly, subscribe to the channel and leave a comment with the number 1 below. To understand why that jump happened, you have to forget everything you have been taught about how markets are supposed to move. In a normal environment, a 5% move takes time. Buyers step in, sellers respond, price negotiates its way higher. It is a conversation. What we saw was not a conversation. It was silence, followed by hard impact. I was watching the order flow as the market opened. Early in the session, a single buy order hit the system. It was not dramatic. In any healthy market, it would have moved the price a few cents. But this was not a healthy market. It was Ghost Week. Senior risk managers were gone. Desks were understaffed. The order book was totally hollow. That order did not meet resistance at 72.50. There were no offers at 73, none at 73.50. The matching engine kept scanning higher, searching for anyone willing to sell. It finally found liquidity near 74. In one single sweep, the price skipped entire levels. That is exactly what a liquidity vacuum looks like. When there is no atmosphere, there is no drag. Price does not glide. It falls or rises freely. This is what traders call an air pocket. It is a zone where the usual rules stop applying because there is nothing left to slow the move down here. Here is the critical part most people missed. The buying was not aggressive. This was not a squeeze. This was not panic. It was mild positioning from a handful of funds preparing for January. If that level of demand can force price to jump dollars instead of cents, imagine what happens when real volume returns now. This move exposed something far more important than a breakout level. It exposed the absence of sellers. When nobody is willing to part with inventory, even small demand becomes explosive. The market does not need excitement. It only needs scarcity here. And true scarcity is exactly what revealed itself today. If this was the result of cautious buying in a thin market, then the real question becomes unavoidable. What happens when the calendar turns and the market fills back up now? What happened next confirmed that this move was not random. It was structural. The moment silver pushed beyond the previous highs, something critical changed. The market entered what traders call blue sky. Above that level, there is no history. No trapped sellers, no overhead supply waiting to escape at all. Technical analysts love to draw resistance lines. They mark 72.50, 73, 74 as if those numbers carry meaning on their own. But resistance is not a line. It is memory. It represents investors who bought at a price and spent years underwater. When price returns, they sell to relieve the pain. That selling pressure creates pure gravity. But at 75, there was no pain left to relieve. Every participant in the market was in profit. No one was waiting to get their money back, and when that happens, sellers step aside. They go on strike. Price does not rise because buyers are aggressive. It rises because sellers refuse to appear now. We saw attempts to push the market down. Brief dips lasted minutes, not hours. Each time buying emerged instantly. This was not emotional, it was mechanical. Arbitrage systems saw higher prices elsewhere and stepped in automatically. The floor was not psychological, it was purely structural. Then the trading machines flipped. For more than a decade, algorithms were trained to fade strength in silver. Rallies were shorted, breakouts were sold. That logic works in a capped market. But when price clears a multi-decade high, the code changes. Momentum systems turn on. Instead of selling rallies, they chase them now. They do not care about value. They do not care about narratives. They care about price direction. Once that switch flipped, price stopped behaving normally. Moves accelerated. Each new high triggered additional buying, not selling. The market was not discovering a price, it was discovering the absence of resistance here. And while this was happening, the most telling signal of all appeared: total silence. Financial media ignored the move. No urgency, no explanation. That silence was not ignorance, it was discomfort. When markets move without permission, without a tidy story, professionals freeze. Denial comes first here. And denial, historically, is the opening stage of every single major cycle. While most people were focused on the number on their screen, the real signal was coming from somewhere else entirely. It was not in New York. It was not in London. It was in Asia. And what was happening there made the move in the U.S. look small now. As silver printed 75 in the States, the price in China was already operating in a different reality. The Shanghai market was trading the same metal at a massive premium, not a few cents, dollars, an $8+ gap between East and West here. In a functioning global market, that gap should not exist. Arbitrage is supposed to erase it instantly. Buy where it is cheap, sell where it is expensive, and the prices converge. That is the glue that holds global markets together. But the glue failed today. The gap did not close, it actually widened. That tells you something is broken. Not sentiment, not speculation, logistics. The banks can move paper contracts all day, but they cannot move the metal. They cannot source it, ship it, insure it, and deliver it fast enough to capture the spread. The inventory simply is not there now. This is the precise moment where paper price and physical price begin to divorce. China is not speculating. The buyers paying that premium are not traders chasing momentum. They are industrial consumers securing supply. Solar manufacturers, battery producers, factories that cannot operate without silver. For them, price is irrelevant. Availability is everything here. If silver adds $20 to the cost of a finished product, it does not matter. What matters is that production does not stop. That makes these buyers price inelastic. They do not negotiate. They secure metal. And when the largest physical consumer in the world is willing to pay more than the quoted global price, that quoted price becomes a lagging indicator. New York is not leading this market anymore. It is chasing it now. The Shanghai price is not just the outlier. It is simply the preview. This is where the pressure begins to compound. That price gap between East and West is not just an anomaly, it is a magnet. Every algorithm, every arbitrage model still operating sees the same signal: buy here, sell there. Even if the metal cannot physically move, the attempt to close that gap forces buying pressure in New York now. And here is the trap the market makers are caught in. Normally, if prices move too fast, banks step in. They dump paper supply, cool things down, restore order. But this time they cannot. If they push the paper price down while China is bidding aggressively higher, they only widen the gap here. As the spread gets wider, the incentive screams for someone to finally come in and drain what little physical inventory still remains. So they are truly frozen. They can't tamp price without risking a physical run on vaults. They can't let it rise without bleeding on short exposure. This is what checkmate looks like in a commodity market now. That's why this move has teeth. It isn't driven by optimism, it's driven by constraint. The system is cornered by its structure. The paper market is oversized, the physical market is exhausted, and the bridge between them is breaking fast. Every tick higher increases stress on short positions. Every dip is absorbed faster than the last. This isn't a trend that fades, it's a feedback loop. Rising price tightens supply, tight supply accelerates price, and the spread pulls everything up. That's why 75 isn't expensive. It's discounted relative to where real demand is clearing, discounted relative to what physical buyers are already paying, discounted relative to a system that's realizing too late that promises can't replace inventory. When markets reach this stage, they stop behaving rationally. They start behaving urgently now. And urgency simply doesn't negotiate. Up to this point, everything we've discussed has been mechanical. Liquidity, inventory, arbitrage failure, but markets don't move on mechanics alone. They move on perception of risk. And this is where the tone shifted from opportunity to protection. While most people were watching, the price algorithms were watching headlines, not opinions, not commentary, raw signals, keywords that trigger regime changes. And when those signals hit, the behavior of capital changed instantly for good. This is the moment where money stops asking how much it can make and starts asking how much it can lose entirely. When geopolitical risk rises, certain assets stop being trades and become shelters. Currency exposure is reduced, duration risk is cut, and capital moves toward assets with no counterparty dependency. This shift doesn't require panic. It only requires a probability change in risk models. And those models have now flipped. When uncertainty moves from economic to strategic, the tolerance for paper claims collapses. Futures contracts, promises of delivery, leveraged exposure, all of it carries a hidden assumption: stability. When that assumption weakens even slightly, the premium on immediacy explodes. That's what you're seeing now, a repricing of certainty. Silver sits in a unique position in that environment. It's monetary, but it's also essential. It's portable, but it's also consumed. That dual role makes it extremely sensitive to stress in global systems. When supply chains feel fragile, the market doesn't wait for confirmation. It front-runs the risk. And here's the critical insight. This shift didn't happen during peak volume. It happened during the thinnest conditions of the year. That means price didn't just respond, it overreacted, not because the move was wrong, but because there was nothing to slow it down. When fear collides with emptiness, price doesn't adjust. It totally revalues. And once that door opens, it certainly doesn't close quietly. Now we need to talk about structure, because what silver just did is not ordinary. It didn't simply break a resistance level. It exited an era. For decades, silver lived inside a massive compression zone, capped and suppressed. That ceiling is gone. When an asset breaks a multi-decade high, it enters price discovery. Use the phrase casually, but the implications are extreme. In price discovery, there is no reference point, no ceiling, no fair value anchor. The market isn't negotiating it, it's searching. And searching is truly violent. Every rally before this was a fight against trapped sellers. This rally has none. Everyone who owns silver is winning. That removes the natural supply. It creates a seller's strike. Holders don't liquidate strength, they protect it. This is where volatility really accelerates. Algorithms that once fated rallies now chase them. Options markets add fuel. As price moves through key strikes, dealers are forced to hedge by buying futures. That hedging pushes price higher, which forces more hedging. It's a mechanical feedback loop layered on top of an already tight market. That's why moves start to staircase, not smooth curves, sudden jumps. Each level becomes a new floor because there's no overhead supply to push price back down. But there's a warning embedded here. Blue sky works both ways. Thin liquidity means sharp drops can happen as easily as sharp rallies. Sudden paper sell-offs can create violent wicks designed to shake out weak hands. This is where leverage becomes lethal. The trend isn't fragile, but the path is certainly not gentle. If you understand that, you stop reacting to noise and start respecting structure. Because once price discovery begins, the destination matters less than the fact that there is simply no ceiling to stop it. The most important thing to understand is who is not in this market yet. The move you've seen so far was driven by automation, thin desks, and reactive capital. It was not driven by the largest pools of money. Those players are still on the sidelines, and that's what makes this moment dangerous. Institutional capital moves slowly, but when it moves, it overwhelms everything. Pension funds and asset managers don't chase momentum. They respond to mandates and career risk, and once an asset forces its way onto their radar, hesitation disappears. Right now, those decision makers are looking at the same data you are. They're seeing a breakout into price discovery. They're seeing physical shortages. They're seeing a global price split that shouldn't exist. And they're realizing they have no exposure. In that world, being underallocated is not neutral. It's dangerous. If silver continues higher and they're not positioned, someone loses a job. That fear is far more powerful than greed. It forces action. Here's the problem. The silver market is tiny. It cannot absorb institutional demand smoothly. A 1% allocation shift from global managed assets would overwhelm available supply instantly. That's not speculation, that's just arithmetic. When those orders hit, they won't look for pullbacks. They'll lift offers, they'll chase liquidity, they'll pay whatever price is required. And when that happens in a market experiencing a seller's strike price doesn't trend upward, it gaps. This is why the real volatility hasn't started yet. What you've seen so far is the prelude, the warning tremor before the earthquake, the calm before capital re-enters a market that can't handle it. This is where psychology becomes the battlefield. As price accelerates, the biggest threat is no longer the market, it's the decision-making of the participant. Rapid gains create pressure. Screens flash numbers that feel unreal. And the instinct to lock it in becomes overwhelming. This is the precise moment where most people lose the most. Retail traders are conditioned to sell breakouts. They're taught to fear new highs, to assume reversals, to grab profits quickly before they fade. Institutions are trained to do the opposite. They buy confirmation, they buy strength, they buy when the trend proves itself, not before. That difference is where wealth actually transfers. When price pushes into unfamiliar territory, every pullback feels dangerous. Every headline feels like a reason to exit. But those reactions come from discomfort, not analysis. Humans are wired to avoid uncertainty, and price discovery is pure uncertainty. Here's the paradox. The higher price goes, the safer the trend becomes structurally, even as it feels more dangerous emotionally. New highs eliminate resistance. They force shorts to cover. They attract capital that can't afford to miss the move, and each of those forces reinforces it. This is why violent pullbacks don't invalidate the move. They strengthen it. They remove leverage. They flush weak hands. They transfer inventory from impatient to strategic holders. If you want comfort, this is the wrong spot. Price discovery is not calm. It's not polite. It's not linear. But it is honest. It reveals who understands structure and who reacts to noise. The mistake most people make here is assuming they are late. They confuse acceleration with exhaustion. In reality, acceleration often marks the beginning of the most powerful phase of a cycle, not the end. So the big question remains, how do you manage your stack through the coming chaos without wrecking your position? Here, strategy must override hype. When silver enters true price discovery, the goal isn't calling every dip, it is avoiding unforced errors on your part. The major error now isn't misjudging the trend, it is panic selling your ounces during high volatility. First, grasp the reality of this move. The shiny isn't climbing due to hype. It is rising because faith in fiat is collapsing globally right now. Liquidity is drying up. Physical inventory is tight. Wealth is fleeing to hard assets. These trends span major cycles, not just days. Second, no spot price isn't value. Big dips aren't failures here. They are structural events, liquidity gaps, forced washouts, and market resets. If the shortage fundamentals hold true, this volatility is purely distraction, not a danger signal. Third, never use leverage. In rigged markets, debt doesn't boost gains, it magnifies fatal errors. You can be right on silver and still get liquidated. Real strength comes from holding physical, not gambling. Above all, remember why you stack silver. If your goal is insurance scarcity and true value, then paper price drops have no power over your mind. You simply cannot trade a global currency reset the same way you trade a normal range. These manipulated markets do not reward perfection. They reward strong hands. The triple-digit silver talk isn't about a digital fiat price. It is about what occurs when money rushes into tight supply as faith in paper dies out. When that day finally arrives, the price won't ask for any permission. So stay grounded, keep stacking, let the fundamentals work. If this helped you understand the stacker mindset better, please subscribe to the channel. Share this with a fellow stacker who needs clarity and drop a comment with your own strategy below. The bull run is not over yet. It is truly just starting.